Hello, I'm Ari Warokka, presenting my research paper titled From Emissions to Economy, Company Characteristics and Carbon Disclosure in Southeast Asia. This study investigates how specific company characteristics, such as profitability, leverage, and growth, affect carbon emission disclosures in key ASEAN countries, and how these disclosures, in turn, impact economic indicators like trading volume and stock price volatility. As transparency in environmental practices becomes increasingly crucial, these findings offer valuable insights for sustainable business strategies across Southeast Asia. Carbon emissions and climate change are major challenges globally. Industrialization and rising consumption levels are key contributors, with emissions expected to increase by 50% by 2050 if left unchecked, according to the OECD. To combat this, carbon disclosure has become essential. By being transparent about emissions, companies can build trust and credibility, support a low-carbon economy, and address stakeholder expectations, all while reduces information gaps. In Southeast Asia, countries like Thailand, Malaysia, and Indonesia are significant carbon emitters facing serious climate risks. Yet, emissions disclosure in this region remains low, especially for Scope 3 emissions, which cover indirect environmental impacts. Key company characteristics affect the depth and clarity of disclosures, which this research explores, linking transparency to better economic outcomes. These disclosures can attract investors, reduce share price volatility, and enhance reputation, promoting both sustainable growth and corporate responsibility. This research investigates how company characteristics affect carbon emission disclosure and analyzes how carbon emission disclosure influences decision-making behavior or economic consequences. This research makes several important contributions to our understanding of carbon emission disclosures in the ASEAN region. It provides new insights into how company characteristics influence carbon disclosure practices. A unique contribution of this study is the introduction of a comprehensive model that links the factors influencing carbon disclosure with its economic outcomes, offering a holistic understanding of both the drivers and impacts of disclosure. The research specifically focuses on the 4 highest carbon-emitting ASEAN countries: Thailand, Malaysia, Indonesia, and the Philippines, highlighting that carbon disclosure rates in developing nations are lower than in developed countries, showing a clear need for region-specific strategies. These findings are essential for companies, offering guidance on how to manage carbon disclosures effectively and understand the related economic consequences. This knowledge can help firms in ASEAN and beyond enhance transparency and navigate the demands of a sustainability-focused market. This research focuses on key company characteristics that impact carbon emission disclosure. First, profitability. Profitable companies are more likely to disclose environmental data due to their financial strength and societal pressures. Next, leverage. Companies with higher debt levels often disclose carbon data to maintain transparency with investors. Company size also plays a role. Larger companies face more public and stakeholder pressure, leading to greater transparency in carbon disclosures. Finally, sales growth. High-growth companies may disclose emissions to support sustainability, as growth often brings increased resource use. This study also investigates the economic consequences of carbon emission disclosure. Bid-ask spread. By decreasing information asymmetry, disclosure can reduce bid-ask spreads and market uncertainty. Trading volume. Transparency encourages trading activity, potentially boosting stock trading volume. Share price volatility. Environmental disclosures help reduce volatility by closing information gaps in the capital market. Together, these insights highlight how carbon emission disclosures are influenced by company characteristics and how they affect economic outcomes in the market. This research developed 7 hypotheses represented in our model. Hypothesis 1. Profitability has a positive effect on carbon emissions disclosure. Hypothesis 2. Leverage has a positive impact on carbon emissions disclosure. Hypothesis 3. Company size has a positive effect on carbon emissions disclosure. Hypothesis 4. Sales growth has a positive impact on carbon emissions disclosure. In terms of economic consequences, Hypothesis 5, disclosure of a company's carbon emissions has a negative effect on the bid-ask spread. Hypothesis 6, disclosure of company carbon emissions has a positive effect on stock trading volume. Hypothesis 7, disclosure of company carbon emissions has a negative effect on stock price volatility. These hypotheses aim to deepen our understanding of the factors driving carbon emissions disclosure and its broader economic implications. This research focuses on non-financial companies listed on the stock exchanges of Indonesia, Malaysia, Thailand, Vietnam, and the Philippines. These countries were chosen due to their status as the highest carbon-emitting nations in the ASEAN region. This research gathered data from financial statements, annual publications, and environmental information report from 2008 to 2017. The carbon emission disclosure variable is assessed using measurement by the Carbon Disclosure Project, which divides it into 5 large categories, namely climate change risks and opportunities, greenhouse gas emissions, energy consumption, greenhouse gas reduction and costs, and accountability of carbon emissions. Company characteristics examined were profitability, measured by return on assets, ROA, leverage, by debt ratio, company size, by the natural logarithm of total assets, and growth, by sales growth. The data was analyzed using partial least squares structural equation modeling, PLS-SEM, and processed with WARP, PLS-SEM 5.0 software. This research employs the PLS-SEM method due to its numerous advantages and its suitability for the studied research model. The validity analysis showed that most variables met the convergent validity criterion with AVE values above 0.50. However, growth and bid-ask had slightly lower AVE values, though full collinearity VIF values between 3.3 and 5 indicated no multicollinearity issues. For discriminant validity, the square root of AVE was compared with construct correlations, confirming good discriminant validity, as values on the diagonal were higher than interconstruct correlations. The R-squared values indicate that the independent variables moderately explain carbon emission disclosure with an R-squared of 0.323, while explanatory power for price, trade, and bid-ask was weaker. Effect size analysis showed that most variables had a small impact on endogenous variables, except for growth, which had a moderate effect on carbon emission disclosure. In hypothesis testing, only 3 out of 7 hypotheses were supported, specifically Hypothesis 1, 3, and 6. The leverage factor, Hypothesis 2, did not significantly influence carbon emissions disclosure, while Hypothesis 4, 5, and 7 showed results opposite to expectations. Next, let's dive into the key findings of this research, exploring how specific company characteristics influence carbon emission disclosure practices. First, profitability has a positive effect, confirming that profitable companies are more likely to disclose emissions as they seek to demonstrate both environmental responsibility and strong management. This aligns with prior studies. Next, leverage didn't significantly impact disclosure, which goes against expectations. While prior research suggested that highly leveraged companies would disclose more to satisfy stakeholders, our findings indicate stakeholders may show less interest in companies with high financial risk and limited environmental focus. Company size, however, does positively influence disclosure. Larger companies, under greater societal and stakeholder pressure, tend to be more transparent about emissions, which supports legitimacy theory. Lastly, sales growth showed an unexpected negative effect. Companies with high sales growth tend to deprioritize emissions disclosure, likely focusing on financial performance over environmental reporting, especially in growth-focused, developing regions. In summary, these results highlight how company characteristics play varied roles in shaping carbon disclosure practices. This research examined the impact of carbon emission disclosure on key financial market metrics. Carbon emission disclosure was found to positively affect the bid-ask spread, contrary to our hypothesis, suggesting that increased carbon disclosure might heighten market uncertainty, a finding consistent with de Klerk and colleagues. Carbon disclosure also increased trading volume, supporting our hypothesis and indicating strong investor interest in companies practicing environmental transparency, as Hitzeman and Zhou noted. Lastly, contrary to expectations, carbon disclosure increased share price volatility rather than reducing it. This challenges earlier studies but aligns with de Klerk and Hapsoro, suggesting that while thorough carbon reporting may raise price fluctuations, it also attracts investors by lowering perceived risks. These findings reveal the nuanced role of carbon transparency in influencing market behavior and investor confidence. The findings of this research offer significant practical implications for both practitioners and investors in their investment decisions. It is advisable for investors to carefully consider whether companies provide reports on carbon emissions and their management practices. As global developments increasingly prioritize climate management in investing, the emergence of green bonds in the ASEAN region underscores the growing importance of sustainable practices. For future research, a comparative analysis of industries within each country could provide valuable insights, considering the varying levels of carbon emissions across different sectors. Additionally, incorporating variables such as manager characteristics and mass media exposure could further enhance the understanding of the factors influencing carbon emission disclosure and its economic consequences. Thank you for watching my presentation. I hope this research provides meaningful insights into how company characteristics influence carbon disclosure and its economic consequences in Southeast Asia. As we move toward more transparent and sustainable business practices, I believe this study can contribute to both academic discussion and corporate decision-making. If you have any questions or would like to discuss this topic further, feel free to contact me. Thank you again, and I look forward to future collaboration and discussion.